There is a particular kind of danger that arrives not as a single catastrophic blow, but as the convergence of multiple serious problems at precisely the moment when the system carrying them has the least capacity to absorb the shock. Economists have a word for the most feared version of that convergence. They call it stagflation, rising prices and falling growth simultaneously. The condition that breaks the standard toolkit of every central bank on earth, because the medicine for inflation kills growth and the medicine for recession kills the currency. The condition that the 1970s generation experienced and never forgot. The condition that the mainstream consensus as recently as last week was telling you was safely in the rearview mirror of the post-pandemic recovery. I am here to tell you this morning, with the data that is now in front of us, that stagflation is no longer a tail risk. It is the base case trajectory of the global economy if this Iran war persists beyond the next few weeks. And I want to walk you through, with the precision and honesty that this moment demands, exactly why I believe that, what the transmission mechanisms are, and what it means for the decisions that ordinary people and institutions need to make right now. But before I do that, I want to address something that I think is being fundamentally misrepresented in the mainstream financial commentary about this conflict. The argument being made by institutions like Oxford Economics, by certain Wall Street strategists, by the consensus view that is currently being served to retail investors through the financial media, is essentially this: do not panic. The conflict will likely end within 2 months. Sell the extreme moves. Buy the dip in Gulf and Asian assets when fear peaks. I understand why that argument is being made. It is the historically defensible argument. Most Middle East conflicts have indeed produced temporary oil price spikes that faded within weeks as diplomatic resolution arrived. The pattern is well documented, and the institutions making this argument are not making it in bad faith. But I believe that argument is wrong this time, and I want to explain precisely why the historical analogy breaks down and why the structural conditions surrounding this particular conflict are categorically different from previous episodes. The first difference is the tariff context. This is something I have not heard a single mainstream analyst discuss with the seriousness it deserves. The Iran war is not landing on a clean, well-functioning global economy in an otherwise stable environment. It is landing on an economy that was already absorbing the largest coordinated tariff shock in the history of the post-war trading system. The Trump administration's historic tariff increases implemented in the first weeks of 2026 had already introduced a significant supply-side inflationary impulse into the American and global economy before the first missile was fired at Tehran. Bloomberg Economics confirmed this directly. The Iran war threatens to deal a severe blow to a global economy, still grappling with the impact of Trump's historic tariff hike. Those are not my words. Those are the words of one of the most establishment financial institutions on earth. The tariff shock and the energy shock are now operating simultaneously, each amplifying the other, creating a compound inflationary environment of a kind that the Federal Reserve's models were simply not designed to handle. Think about what that means in practical terms. Tariffs raise the price of imported goods. Oil price spikes raise the cost of producing and transporting all goods. These are not two independent inflationary forces that can be managed separately. They interact. Higher energy costs raise the production cost of every good subject to tariffs. Higher tariffs raise the price of every good whose production uses imported energy inputs. The feedback loops between these two shocks create an inflationary spiral that is significantly more persistent and more difficult to extinguish than either shock operating alone. And this is arriving at a moment when, as Bloomberg correctly noted, the Federal Reserve is already in an impossible position, stuck between a war that pushes inflation higher and a president demanding that interest rates come down. The Fed cannot cut rates without abandoning its inflation mandate. It cannot raise rates without potentially tipping an already slowing economy into recession and triggering the debt crisis that has been building in the shadows of the financial system for the past 3 years. That is not a difficult policy choice with a right answer. That is a trap with no clean exit. Let me give you the market data that is already confirming this trajectory, because I think it is important to ground this analysis in what is actually happening rather than what we fear might happen. The Dow Jones Industrial Average has already fallen over 400 points since the conflict began. South Korea's KOSPI index, one of the most important barometers of global manufacturing and technology supply chain health, suffered its biggest single-day crash since the 2008 financial crisis, dropping up to 12% and triggering a circuit breaker. The Thai Stock Exchange imposed a trading curb after an 8% decline. Japan's Nikkei dropped over 2%. European natural gas prices rose 38% after attacks on Qatari facilities. Treasury yields, and this is the number I want you to hold in your mind, are sinking as oil jumps, meaning that bond markets are beginning to price in simultaneously both recession risk and inflation risk, which is the precise signature of stagflation positioning by institutional investors. Manufacturing input prices are jumping. West Texas Intermediate crude surged 6.3% in a single session, and this is day 4. The repricing of global risk that is occurring in financial markets right now is not a temporary panic spike. It is the beginning of a structural reassessment of the risk premium embedded in every asset class on Earth. I want to spend considerable time on the emerging markets dimension of this crisis, because I believe it is the most underappreciated vector through which this conflict will produce genuine human catastrophe at a global scale. And because the financial media's focus on American and European economic consequences systematically obscures the severity of what is coming for the developing world. A 10% increase in oil prices raises consumer price inflation in emerging Asian economies by approximately 0.2 percentage points on average. That sounds modest, but in countries where energy has a high weight in the consumer inflation basket, and that means most of South Asia, Southeast Asia, Sub-Saharan Africa, and Central America, the pass-through is not 0.2 percentage points. It is multiples of that. And it arrives on top of inflation levels that were already elevated in economies where central bank credibility was already fragile, in currencies that were already under pressure from a strengthening dollar, in societies where the political tolerance for price increases in food and fuel is measured in weeks rather than quarters. The dollar is strengthening in this environment, which sounds paradoxically positive for American economic prestige, but is in practice deeply destructive to the global system. A stronger dollar tightens financial conditions for every emerging market economy that carries dollar-denominated debt, which is most of them. When the dollar strengthens and oil prices rise simultaneously, you get a double squeeze on emerging market balance sheets. Their import costs rise in dollar terms at the same time that their ability to service dollar debt becomes more expensive in local currency terms. So that dynamic has historically been the precursor to emerging market debt crises. We saw versions of it in 1997 and 1998. We saw a version of it in 2013 with the taper tantrum. The conditions being created right now in the Persian Gulf are generating the same structural dynamics at a larger scale and in a more fragile global debt environment than either of those previous episodes. But I want to go further than the emerging markets of Asia and Africa because there is a geographic dimension to the economic disruption of this conflict that is almost entirely absent from the Western financial press. Central Asia. The landlocked nations of Kazakhstan, Uzbekistan, Turkmenistan, Kyrgyzstan, and Tajikistan have built their access to global markets on trade routes that run south through Iran to Persian Gulf ports, giving them access to the Indian Ocean, to South Asian markets, to European markets via the sea routes around the Arabian Peninsula. The Iran conflict has damaged those trade routes severely. The alternative routes available to these economies run north through Russia via the Volga-Don Canal or west through the Caucasus into Turkey. These are not equivalent substitutes. They are longer, more expensive, more politically constrained, and in the case of the Russian route, subject to their own set of geopolitical complications given the ongoing Western sanctions architecture against Moscow. The economic isolation of Central Asia as a consequence of this conflict is not a headline story anywhere in the Western media. But for the populations of those countries, it represents a serious and potentially prolonged disruption to the economic arteries that their development trajectories depend upon.